Welcome to Looking at the Markets with David Modell. Today we're going to talk about selling covered calls. Is it something you should do? Is it worth it as opposed to just buying and holding the stock? And if you're going to do it, how should you go about it? Alright, so let's start from the beginning. Selling covered calls, the basics. If you bought 100 shares of a popular stock or ETF, then you can get paid a little bit of money right now, basically for nothing. Get free money, right? Okay, well, it's not for nothing. There's always a price to pay. In exchange for receiving a little bit of money up front, you'll be limiting your maximum profit on those 100 shares of stock or ETF that you own. It's fairly easy to get permission from your broker to sell covered calls. That's usually the most basic level of options trading permission, so your broker will probably let you sell covered calls if you apply for permission to do that. Selling covered calls is also known as writing covered calls, or buy write, because you first buy 100 shares of a stock or ETF, and then sell, or write, a call option on those 100 shares. It's a covered call because the option contract conditions are already covered. You already own 100 shares of the stock and are able to provide them, or sell them, if you're assigned. In selling a covered call, you're betting that the stock price probably won't go above a certain price. That's the strike price. The person on the other side of the trade, the guy or gal or institution or whatever who bought the call option contract, is betting that the stock will go above the strike price before expiration. If you sold a covered call and the stock price does go above the strike price and you're assigned, then you'll end up selling your 100 shares of stock at the strike price. That's fine because you'll still make money. You'll make the difference between the price at which you bought the stock and the strike price, plus the option premium that you collected when you sold the covered call option. However, you might feel regretful if the stock price rockets upward and goes far above the strike price, since you could have made more money if you had simply bought and held the 100 shares of stock and not tried to squeeze more money out of the trade by selling a covered call. So let's think about it, all right? And by the way, selling a covered call doesn't give you much protection if the stock price falls a lot. So here's a chart of the profit potential and loss potential. All right. So let's say if you just bought 100 shares of stock, you'd be here. You'd be at break even. Okay. This is all profit up here, above this line. Anything below this, and anything below this line is loss. All right. So if you just bought 100 shares of stock, right now you would break even. And if you got paid a little bit of money for the covered call, a little bit of option premium for selling the covered call, you'd be up here, let's say. All right, and so if the stock price, goes up or down from there, if the stock price goes up, you get paid a little bit more. But here's the strike price, all right, and if the stock price just keeps going up above the stock price, you don't make any more money than that, all right, and so you're limiting your profit potential. That's the price you pay. And so if the stock price just goes up and up and up, stock price keeps going up more and more and more, but meanwhile you limited your profit potential, you limited your max profit here, you might start to feel regretful that you sold the covered call. You might wish you had just bought the 100 shares of stock and held on to it without selling the covered call. And so that's the price you pay. All right? And like I said before, selling a covered call gives you a little bit of downside protection, because let's say you bought the stock, you're here, break even, and then you sold the covered call option, and so you're here now. All right, you got paid a little bit of option premium, great. All right, and so if the stock price goes down a little bit, you're still at break even, and so you get a little bit of downside protection because you got paid a little bit of money up front for selling the covered call, but only a little bit of protection is what you get, because if the stock just keeps going down, you're still losing. You're still losing money. You're not losing as much as if you had just bought the 100 shares of stock and didn't sell the covered call. Okay, but it's not much downside protection. If the stock just keeps plummeting, you're going to lose money. Okay, your losses are just getting bigger and bigger. All right, so we'll look at a few examples, and then we'll examine the research and consider whether it's better to write a covered call or instead just to buy 100 shares of stock and hold on to them. I just quickly wanted to go over the evidence regarding whether it's worth writing covered calls as opposed to just buying and holding a stock or ETF such as SPY representing the S&P 500 or just stocks in general. Because you have to wonder, what does the evidence say? Is it better to buy 100 shares of a stock or ETF and then write a covered call against it, or is it better just to buy and hold the stock or ETF? So I did a little bit of research here on the internet, and Tasty Trade has a pretty good video about it, and they concluded that since the year 2000, selling 30 delta, and that means out of the money, covered calls has outperformed just buying and holding. All right, so according to their research, it looks like buying and holding and writing at the money covered calls on the S&P 500 underperformed compared to buying the S&P 500 and writing out of the money covered calls. So you are actually better off just consistently writing those out of the money covered calls. But then later on in this video, they seem to imply, the Tasty Trade people seem to imply that the buy right strategy of consistently writing covered calls against the 100 shares of stock, or in this case S&P 500, it does better when the S&P 500 doesn't go up much, or if it goes down. Whereas during years when the S&P 500 goes up a lot, you are actually better off just buying and holding compared to writing covered calls. So for example, in a year like 2013, when the S&P 500 just pretty much just went up consistently, it went up about 30% that year, you are actually better off just buying and holding the S&P 500 as opposed to writing covered calls against it. The reason being that when you write covered calls, you limit or cap your potential upside gains. All right, but on the other hand, in a year like 2015, when the S&P 500 just kind of was flat or even went down a little bit, you were definitely better off writing covered calls as opposed to just buying and holding the S&P 500. All right, because at least you would have capped your upside, but there was no upside really to cap here, and so at least you would have collected money from collected premium from selling the covered calls in a year like 2015. All right, so it depends on how much the stock goes up or ETF or index. If it goes up a lot, you were better off buying and holding and not writing covered calls. If it's flat or goes down or only goes up a little bit, then you were better off writing covered calls. But the Tasty Trade video seems to imply that overall, if you sell out of the money covered calls, you'll do a little bit better. All right, and then I looked up some other research. Here's a study where the concluding remarks, and the links are all up here, so you can check these out for yourself if you want to. Here's scientific evidence saying that the results suggest that options-based strategies can be useful in improving the risk-return characteristics of a long equity portfolio. Specifically, the covered combination and covered call strategies consistently outperform the corresponding long stock strategy. This result holds regardless of the measure used to gauge performance or whether one uses the first half, second half, or entire time period. So that's a pretty strong statement there, and this is a 10-year study. And the name of this paper is The Performance of Option-Based Investment Strategies, Evidence for Individual Stocks During 2003 to 2013 by Hemler and Miller. All right, here's another one. Another study Equity in now this is for equity index covered calls, but still that could be used. You could get similar, I imagine, similar results from using ETFs. Equity index covered calls have provided similar average compounded returns to their underlying indexes. So they're saying it's about the same as buy and hold, but with lower volatility, which is a definite plus, and smaller drawdowns. Okay. So, this one says it'll be about the same as if you just bought and held, but lower volatility and smaller drawdowns. That's a good thing. All right, and want to give credit. So this is from Covering the World, Global Evidence on Covered Calls from Israelov, Klein, and Tumala, if I'm pronouncing that correctly. And then here's another one. So let's see. We can blah, blah, blah. Okay, in the latter case, we find a surprising number of cases in which the covered call strategy produces greater returns than the buy and hold strategy, with some evidence that this outcome is statistically significant. All right. Again, not massively better returns, but it may be a little bit better, all right, compared to just buying and holding. And again, it just seems the general idea is that it seems to be that if the stock or whatever or index or ETF that you're buying, if it just shoots up like a rocket for the entire time, then you were better off not writing covered calls. You're better off just buying and holding, as opposed to a flat or slightly up or down year. In those cases, you were better off not. And I'm sorry, in those cases you were better off writing covered calls. But overall, it seems to be slightly advantageous to write the covered calls. All right. So, maybe it just depends on your stance. If you are very, very bullish on something that you bought 100 shares of, then perhaps you're better off not writing covered calls. You're better off just buying and holding. But if you're not super bullish, if you think it might just go sideways or down a little bit, or if you think it's going to go up but not much, then you're better off writing covered calls. So it really depends on your perspective, on your outlook for the stock or index or ETF, or whatever it is you're considering writing covered calls against. So now we're going to look at a few real-life examples. The market is closed right now, but still, I'm on my broker's platform, and you already have to own 100 shares of a stock or ETF in order to sell a covered call on it. All right, so we're going to pretend or assume that you already own 100 shares of stock. All right, and by the way, the stock or ETF has to be optionable. There have to be options available for it. For example, if I type in Dryships, DRYS, yeah, there's a stock there, but there's no option. They don't sell they don't have options for Dryships, so it's not optionable. So it has to be optionable. So usually, if it's one of the more popular stocks or ETFs, then they'll have options available on it. So, for example, Apple, right? They definitely have options on that one. Okay. So let's pretend that I already owned 100 shares of Apple, and I thought, okay, I don't think Apple, I think it's going to go up probably, but not that much. It might just go sideways, or maybe it'll go up a little bit. I don't think it's going to go up like a rocket necessarily. So I want to try to squeeze a little bit more money out of this trade by selling a covered call against my 100 shares of stock. All right, and I'm willing to accept the consequences. If the stock price of Apple does go way up, and I get assigned, meaning I have to sell the 100 shares of Apple at the strike price, I'm okay with that. I accept it beforehand. I'll try not to feel too much regret because I don't want to get emotional about my trading. All right, so you want to pick an expiration date, and usually there's a menu of expiration dates. And I've heard that between 30 and 60 days out from the current date is ideal, especially if you're selling out of the money options, selling out of the money covered calls, which I do recommend. I don't recommend necessarily selling at the money or in the money, especially if you believe that the stock price is going to go up at least a little bit. Otherwise, why would you buy 100 shares of a stock if you didn't think that the stock price was going to go up at least a little bit? All right, so if you're moderately bullish on a stock, then you want to choose a strike price that's out of the money. All right, but first let's think about expiration dates. If you're selling or writing an out of the money covered call, then probably a good way to go is 30 to 60 days out. 45 is just about right. Today's date is the 19th of September, so between 30 and 60 days, we can go, let's say almost 60 days out. Okay, gonna go a little further than I might normally go, but that's all right. We'll collect a little bit more money that way. All right, and the strike price, we want it to be out of the money, but not too far out of the money, because if you go too far out of the money, then you don't collect much of anything. You know, if you go to, I don't know, 200, that's, you know, the strike price way above the current price of 158.67, then you're not going to collect much. You're going to collect 11 or 12 cents per share. All right, you're going to, you know, multiply these by 100 per contract, you'll be collecting 11 or 12 bucks. It's not even worth it. All right, and that's for almost 2 months out. So, you know, you don't want to go that far out with the strike price. So let's get a nice compromise, because if you go at the money, if you go really close to the strike price, let's say 160, you'll collect a decent amount of money. You know, you'll collect between $5.35 or $5.40 per share. So you'll collect 535 or 540 bucks up front. That's nice. But then you'll be limiting your upside so much. You know, if Apple goes up at all, you'll get assigned, pretty soon, very quickly if the Apple stock price goes up, and if Apple stock just goes up and up and up, man, you'll be regretting it. So you want to have a little bit of upside potential in the stock price. So maybe go to 170, 175, even 180. Let's say 175. All right. That way you're collecting between 117 and 120 bucks up front for one contract. Not bad, okay. And you still have some upside potential. What's the maximum per share you can collect? Well, let's pull out the old calculator here, okay? Let's see, we're going to put the calculator here. All right. Oh boy, it's covering up a lot of space here, but that's okay. All right. So the maximum you can collect is the difference between the current stock price where you bought it, or the stock price where you bought it, and the strike price. So that would be $175 per share. That's the strike price, minus the price where you bought it. Let's say you bought it right now at 158.67. All right, so you have $16.33 per share of upside potential from where you bought it. So you could collect that much if it goes up to 175, if Apple goes up to 175 or higher. Plus, remember, you collected some premium up front. Let's say you collected, let's go to the lower end. Let's say you collected 117 per share. So we're going to add the $1.17 of option premium you collected up front. So you could make $17.50 per share, max profit on this trade if Apple goes up to 175 or higher. All right. And so what is that? Well, what percentage gain would that be? Let's divide that by the amount that you paid per share to get a percentage. Divide that by 158.67. All right, and then move the decimal over twice. So you could make about 11% profit on this trade. Not too bad, okay? I'll take 11%. How about you? All right, and so you'll be collecting some money up front. And yes, if Apple stock, after you sold the covered call, if it went way above 175, if it went up to 180, 185, 200, 210 before November 17th, all right, then you might feel a little bit of regret, all right, because you could have made a lot more than 11%. But let's say if the stock price just kind of drifted sideways, Maybe it went up to 160, 165, 170 and just kind of stayed there, or maybe it just stayed around 160, 158, or maybe it went down. Then you'd feel pretty good about the fact that you collected some premium up front, you collected some money up front. You'd feel pretty good about that. And what's more likely to happen? Let's be honest. What's more likely to happen? Is Apple stock more likely to go down or sideways or up a little bit, or is it more likely to shoot up like a rocket way above 175? Well, knowing how the stock market behaves, yes, stock prices do go like a rocket sometimes, but more often than not, it either goes sideways or up moderately or down. And so the odds are pretty good that you'll be glad that you sold the covered call. All right. And so that's just an example. Let's look at another example. I don't know. Again, it has to be a popular one. It has to be optionable. Let's look at Coca-Cola stock. All right. That's a nice, safe stock. All right. And let's say, all right, it's 46.11 right now, and the market is closed. And we'll go a couple months out. So let's think about picking a strike price. You don't want to go too far out because you're not going to collect much. All right. In fact, in this case, you're not going to collect anything. All right. But let's say you go to, 50. Well, see, here's the problem. Even then, you're not collecting much, all right? And so, to me, you're going to collect, what, $2, $3, $4, $5, and there's not much volume there, okay? So this is a case where it's not even worth it, okay? And you could, well, let's go a little closer to the money. Let's see how that goes. 48. All right, you collect a little bit more. You'll collect 17, 18, 19 bucks per contract. But you're really limiting your upside potential. Right now it's $46.11. You can only profit up to if it goes up to 48. Anything above that, you won't even make anything. Let's see what the profit potential for this is. Again, the formula to find out your profit potential is the difference between, let's say you bought it right here at 46.11. So the difference between the strike price and where you bought it. So we're going to do $48 minus 46.11 per share. So you have $1.89 of upside potential from where you bought it. Anything above that you won't gain from. All right. Plus whatever you collected in premium, which is only, let's say, 17 cents a share. So let's add that in. Yeah, about $2, $2.06 per share of profit potential. What percentage is that? Let's divide by the price where you bought it, 46.11. So you can collect 4.5%, 4.46%. So you could make 4.5% on that, and that's over a 2-month period. Is that worth it? 4.5%? Well, that's up to you to decide. That's not a lot of profit. Remember, in the Apple trade, you could have made, 11%? This one's only 4.5%. Remember, Coca-Cola, keep in mind, Coca-Cola is not a big mover. All right, it's probably not going to move as much as Apple. Now, on the other hand, this is a safer stock, usually, and so it's probably, if it goes down, it's probably not going to crash too much. All right. So is this worth it? Maybe. If you don't mind making a moderate profit potential here. Okay. So at least you'll collect a little bit up front, but you're really not collecting much. To me, this wouldn't be worth it. I wouldn't even bother selling a covered call on this one. And so we gave you an example of the Apple trade where, yeah, it might be worth selling the covered call. And the Coca-Cola trade here where you're just not collecting much, all right? And you're really limiting your upside potential here between 46 and 11 cents and 48. That's not much upside potential here for the stock to go up, and you're not collecting much. So it's probably not even really worth it in that case, in my opinion. Okay, so what I want you to do before you start trading with real money is I want you to paper trade it. And, just go ahead and punch in some numbers here. Try different numbers like we just did. Try different expiration dates, and watch the behavior of the call options, and see how much money you can collect. And decide for yourself. Pull out the old calculator there, and decide for yourself whether it's even worth limiting your upside potential. So that's my basic introduction to selling covered calls. I hope you found it informative and helpful. If you did, then please give this video a thumbs up on YouTube and please leave comments. Also, please subscribe to my YouTube channel if you haven't done that already, so you can receive the latest updates on my financial educational videos. And if you need any help with stocks, options, or you want some help putting together a trading or investing plan, you can email me at any time. My email address is davidmodell@gmail.com. Thank you so much. I really appreciate the fact that you're watching and listening to my videos, and I'll talk to you again soon.
Thank you for watching. Please like, comment, and subscribe. And I'll see you next time.